look at the market performance over the course of the last year, it has been incredibly volatile. If we think back to the last few months of 2018, essentially the market went into a meltdown mode, given the Fed that was hiking rates consistently, and at the same time we had the sense that there was some sort of slowdown coming because of the global trade wars. Of course, we know that subsequent to December, when the Fed hiked for the last time, the markets had to reinterpret what the Fed was about to do, and also the Fed came to the rescue by essentially walking back their earlier comments. So for 2019 so far, what we've seen has been only one negative month in terms of equity market performance. This has been of benefit to our Global Growth Fund in particular, because the biggest component of the fund, of course, is sitting in the equity space. But if we then look at the risk factors around the world, we can't always interpret this bad news and an impending slowdown as being the Fed will come to the rescue. So we have to be fairly cautious. We also have to be quite cautious around some of the underlying sectors. In particular, we highlight the tech sector, the darlings of the market, the Googles, the Amazons and so forth, where the implicit growth rates in those stocks are probably too high. So what we have is an underweight position in that. In currency terms, we essentially have a short dollar position, given that some of the tailwinds are now starting to turn into headwinds. We also like the Japanese yen in particular, which has really worked well for us. And then, of course, in the search for yield, what we have is essentially an underweight towards developed market bonds and an overweight in emerging market bonds. So far this year, that has worked really nice for us, and we think that at this stage, we'll remain on a cautious frame and essentially wait to see how the trade war will play out during the rest of this year.